Hey everyone, welcome to the Personal Finance Podcast. I'm Daniel.
And I am Anna.
And we love exploring things about personal finance as well as understanding how global news and trends impact our wallets.
Let us remind you that we are not financial advisors, but we dive into TED Talks, interviews with the best investors, books, news alerts, advisors analysis, and more.
You don't need to be a Wall Street expert to make smart decisions with your money. This episode is for you if you want to be able to think like a CEO of your own life.
Let's dive in.
Hello and welcome back to the Deep Dive. So I want to start us off today with a very specific image in your head.
Okay.
It's Friday night. You've had a long week. You decided to stay in, be responsible, maybe get some takeout. You're in your sweatpants. Mm-hmm. You are, content.
Sounds pretty good so far.
But then you make the fatal mistake. You open Instagram.
The doom scroll.
The destroyer of peace.
Yeah.
And suddenly it looks like every single person you know is at the most incredible party of the year.
Mm-hmm.
And that takeout on your lap starts to look, well, pathetic.
Yeah.
You get that sinking feeling in your stomach, that feeling.
Mm-hmm.
That is FOMO. Fear of missing out.
It's such a universal human experience. I mean, evolutionarily, being left out of the group was basically a death sentence. So we're all sort of hardwired to feel that anxiety.
Like we usually talk about it with, social lives or maybe needing the latest Stanley Cup or something.
Okay.
But today, we are taking that feeling, that anxious, sinking feeling, and we're dragging it into the world of the stock market.
Yeah.
Because it turns out it isn't just ruining your Friday night. It might be actively destroying your wealth.
And not just, earning a little less. We're talking about blowing up entire portfolios.
It's a huge issue. So we're unpacking a stack of research today that paints a pretty alarming picture. We're looking at an article called The Effects of FOMO on Investment Behavior in the Stock Market.
And we're also pairing that with a more practical guide. What is FOMO investing and why is it so dangerous?
So our mission today is really to decode the psychology behind why so many of us, smart people, make really bad money decisions. Why do we buy high and sell low? And what is social media really doing to our brains?
It's a battle, really. A battle between our basic human emotion and financial rationality.
Yeah.
And I'll give you a spoiler. Emotion usually wins.
Okay, so let's get into it. We all think we know what FOMO is. I want what they have. But in investing, how does the research actually define it? Is it just greed?
That's a great question. It feels like greed, but the driver is different. Greed is, I want more. FOMO is more like, I don't want to be the one left behind.
Oh, okay.
The source material defines it as an emotional response to the perception that other people are getting a reward that you're excluded from.
The key word there is excluded, isn't it?
Right. It's not driven by any analysis of the asset's value. The thought process isn't, this company is undervalued. It's, my neighbor is getting rich off this, and I'm terrified I'll be the only one left behind.
So it's about avoiding regret.
Exactly. It's a defensive feeling, but it leads to these really impulsive, offensive actions. The fear of regret just completely overrides the rational part of your brain that should be assessing risk.
So the question shifts from, is this a good investment?
Yeah.
To, will I feel stupid if I miss this?
Precisely. And that's what leads directly to this classic fear and greed cycle. The oldest wisdom in investing is buy low, sell high.
Right. It's the only way to make money.
But FOMO just flips that entire logic on its head. It pushes you to do the exact opposite, to buy high and sell low.
Okay, walk me through that. Because logically, I know I shouldn't buy a stock when it's at an all-time high. So why do we do it?
Well, think about the cycle. When is a stock skyrocketing? It's when everyone's talking about it, right? It's on the news. It's all over Twitter.
Your Uber driver is giving you tips on it.
Exactly. That social proof triggers the FOMO. You think, wow, this is the new big thing I have to get in now. So you buy. You buy at the peak. You buy high.
And then the market turns, as it always does.
Right. The market corrects. Prices start to fall. And now the other side of that emotional coin kicks in. Fear. Panic.
You're not thinking long-term anymore.
No, you're just staring at the red on your screen thinking, it's going to zero, I have to get out now, save what's left. So you sell. You just bought high and sold low.
You've essentially paid a premium to lose money.
You have. And it's so counterintuitive, but our brains are chemically wired to fall into that trap.
Okay, I want to play devil's advocate for a second. You keep using the word rational, but isn't there like a whole economic theory that says the market is rational? The efficient market hypothesis.
Yes, the EMH. That's the classic textbook theory. And it suggests that markets are efficient precisely because they're driven by rational actors.
Rational actors.
Yeah.
Sounds robotic.
Think of a market full of Spocks from Star Trek. You know, everyone logically analyzes all the available information, and so the price of a stock always reflects its true value.
But the research we're looking at today seems to say the theory is, well, kind of garbage.
It's not garbage, it's just incomplete. It totally ignores the human element. So behavioral finance, which is the field we're in now, it challenges the EMH. It argues that markets are actually full of irrational actors.
People driven by things like FOMO.
Exactly. So the market isn't a calculator, it's more like a mood ring. It reflects the collective emotional state of millions of people. And lately, that mood has been swinging faster than ever.
Which brings us to the why now question. Because investing used to be so boring, it was slow, you had time to cool off before you made a trade.
And that's about the accelerants. The research points heavily to technology as this massive catalyst. Investing has gone from a slow, calculated activity to a constant, instant stream of triggers.
It's the smartphone, the trading apps in our pockets that have basically gamified the whole thing.
It's absolute gamification. I mean, think about the design of these apps. You make a trade and confetti explodes on your screen.
Right, or you get a push notification because a stock moved 5%.
It's designed to trigger dopamine, just like a slot machine. All the friction is gone. You can lose your life savings while you're waiting for a latte.
And then you layer social media on top of that. Twitter, Reddit, YouTube.
And that's the big one. These platforms give you real-time updates, which sounds good, but what they really give you is a highlight reel. You're constantly exposed to what they call survivorship bias.
We only see the winners.
We only see the winners. You see the Reddit screenshot of a 500% return. You see the guy who bought a Lamborghini. You don't see the 10,000 other people who lost everything on that same trade.
Yeah, nobody posts a screenshot of their portfolio down 60% saying, look how bad I am at this.
Right. So this creates what the author calls fertile ground for FOMO. It distorts reality and makes you feel like the window of opportunity is closing with every single second that you're not clicking buy.
And the research also says this doesn't affect everyone equally. Who's the most vulnerable here?
It does affect everyone, but the data shows that younger generations, so millennials and Gen Z, are significantly more susceptible.
Is that just a phone thing?
That's a big part of it. They're digital natives.
Right.
But it's also about where they get their advice. They rely more on social media influencers than, say, a traditional financial advisor, and they just generally have a higher inclination toward risk.
It creates a kind of echo chamber, doesn't it? The source mentioned groupthink.
Yes, and that is a critical concept. These online communities, like Wall Street Bets, they foster this sense of shared purpose. We're all in this together.
But it leads to herd behavior.
It does. Instead of doing their own analysis, people just follow the crowd. The assumption is, well, they must know something I don't.
Which leads us directly into some of the wildest moments in recent financial history. The COVID-19 surge, for example.
That was a perfect laboratory for this. The research points to that time right after the initial lockdowns. You had stimulus checks, super low interest rates.
A lot of cash floating around.
Yeah.
And a lot of people stuck at home with nothing to do but trade.
Precisely. Retail investors just rushed in, the market was climbing, and nobody wanted to miss out. But this whole thing really peaked with the meme stocks.
Oh, GameStop and AMC. I remember this so vividly. It felt like a revolution, like the little guy was finally sticking it to Wall Street. It was honestly exhilarating to watch.
It was a powerful narrative, for sure. But if you look at the mechanics, it was a prime example of FOMO. Stock prices were skyrocketing, not because the companies were suddenly amazing.
I mean, GameStop was a struggling mall store.
Exactly. The price was completely detached from the actual value of the business. It was driven purely by social media hype.
To the moon.
To the moon, right. People were buying at $300, $400 a share, thinking it would go to $1,000 just because everyone else said it would. They were buying the momentum, not the company.
And the sources note that, yeah, some people got rich, the ones who got in and out early.
But many, many more suffered huge losses when that bubble inevitably burst. Because that's the thing about bubbles built on FOMO, there's no foundation. When the mood shifts, it all collapses.
And this leads to a bigger problem, right? The source talks about asset bubbles. Why should someone who wasn't buying GameStop care?
Because bubbles threaten the entire system. When prices get artificially inflated, they become detached from reality. And when they pop, it can cause a crisis, it can hurt pension funds, it destabilizes the whole financial system.
The research also mentioned crypto in the same breath, right?
It did, yeah. It categorizes cryptocurrencies as highly speculative assets driven by that same fear of missing out on future gains. It's the same psychology. I have to get on the train, regardless of the underlying utility.
Okay, so we've got the big picture bubbles, crashes, but let's zoom back in on the individual. What does this look like for the average person? The sources gave some really specific examples.
Right. One of the most damaging behaviors they identified is overtrading.
So just buying and selling too often, why is that so bad? You'd think being active is good.
Counterintuitively, no. Activity does not equal achievement here. FOMO makes you feel like you have to do something, so you sell what isn't moving to buy what is. But every trade costs you something.
Transaction fees, you mean?
Fees, yes, but also the spread between the buy and sell price. And the big one is taxes. If you sell for a profit within a year, you're paying much higher short-term capital gains tax.
So all that churning just eats away at your return.
It really does. It's short-termism. You're chasing those immediate dopamine hits instead of letting your money compound over the long term.
And the practical guide, it gave us a couple of real-world examples. Let's talk about Raj.
Raj, the engineer, yeah, very relatable. He's 32, smart guy, works in tech. He invested heavily in a trending mid-cap fund.
Which can be a totally fine investment.
Can be, but why did he buy it? Did he research it? Did he look at the fund's history?
No. He saw it on YouTube.
He saw it on YouTube. It was trending. So when the market dipped, as it always does, he had no real conviction in his own investment.
He's renting someone else's conviction.
That's a perfect way to put it, renting conviction. So when things got volatile, he panicked. The fear took over and he sold at a loss. He bought high on FOMO, sold low on panic.
And then there's Meera. And her story, I think a lot of people can relate to this one, especially from 2020.
Meera is the panic seller. She actually had a good plan. She was using SEP systematic investment plans, just putting in a fixed amount every month. It's usually the perfect antidote to this stuff.
But she broke her own rule?
She did. When the COVID crash happened in March 2020, she got scared and she just stopped her investments. She froze.
And the source says that was a huge mistake.
A massive mistake. Because if she had just stayed the course, her portfolio would have fully recovered and grown significantly by 2023. By stopping, she locked in her losses and, more importantly, she missed the entire recovery.
It's the other side of FOMO, isn't it? The fear of losing what you have, which makes you abandon the very plan that was supposed to build your wealth.
They're two sides of the same emotional coin. Both involve abandoning a long-term strategy because of a short-term feeling.
So, how do we stop this cycle? The source material had a self-checklist, which I thought was great.
It's a really useful tool. We can run through it. So for everyone listening, just mentally check these boxes if they apply to you. Be honest.
Okay, number 1. Do you check your portfolio multiple times a day?
That's a big red flag. It shows you're obsessed with short-term noise.
Number 2. Do you follow finance influencers for hot tips?
Looking for a lottery ticket, not an investment plan.
Okay, number 3. Do you pause your investments when the market dips?
That's the Meera mistake. Trying to time the market rarely works.
Number 4. Do you compare your returns to your friends or the headlines? You know, Dave made 20%, I only made 7.
That's the root of FOMO right there, social comparison.
And finally, do you feel regret after almost every decision? I should have bought more, I should have sold sooner.
The source's verdict is pretty clear. If you checked 3 or more of those, you're likely an emotional investor. You need some structure.
Structure, it sounds so boring. But in investing, boring is.
Boring is profitable. Excitement is usually very, very expensive. And the solution starts with financial literacy. That is your number 1 defense against hype. If you understand what you're buying, a random Reddit post won't sway you.
They also mention intentionality.
Yeah. The goal isn't to suppress emotion. That's impossible. We're human. The goal is to manage it, to recognize, okay, I'm feeling FOMO right now, and then choose not to act on it.
And having a long-term strategy seems key, like the automatic investments Meera was doing.
Exactly. Adopt a strategy that automates your discipline. Dollar cost averaging, for example. You invest the same amount every month no matter what. It removes the decision and it removes the anxiety.
You build a system to save you from yourself.
That's it.
There was one last recommendation, and it wasn't for us as investors, but for the system itself.
Right. The expert source suggests we need some kind of regulatory intervention, specifically targeting the misinformation on these digital platforms. If social media is the accelerant, maybe we need some speed bumps.
That's a fascinating point. It's not just fix yourself, it's fix the environment that's designed to trick you.
Because the environment is currently designed to trigger these biases. The algorithms don't care about your financial health, they care about engagement.
So, to recap our deep dive, FOMO isn't just a feeling. It's a behavioral bias that leads to overtrading, it creates bubbles, and it destroys wealth.
And it's amplified by social media, making the entire market less rational. It turns the stock market from a weighing machine, which measures value, into a voting machine where only popularity matters.
Before we go, I want to leave everyone with one last thought. The research touched on a concept that I can't stop thinking about: sustainability.
This is the big unanswered question.
If everyone is investing based on FOMO, if we're all just following the herd, who is actually looking at the value of what we're buying?
Who's checking if the company actually makes any money?
Exactly. We're all just buying because someone else is buying. The whole thing is just a massive game of musical chairs.
And when the music stops, and it always stops, who is left holding the bag? The system relies on someone doing the homework. If no one does, the entire thing just becomes a casino.
A casino where the house always wins. Thank you for joining us on this deep dive. Hopefully next time you feel that itch to buy the latest hot stock, you'll take a breath and think about your plan. See you next time.